Hi, everyone. It's great to see everybody here today. My name is Chelsea,
My name is Malka.
and welcome to our first ever Women and Investing Masterclass. Malk and I are going to introduce ourselves in a quick minute, but first I wanted to kick off and let you know what we're going to talk about today. So first of all, we'll talk about who the BCSC is, what we do. We'll talk about knowing yourself, your financial self, building wealth, getting advice on investments, and we'll touch on a few ways you can protect yourself from investment fraud. And we'll end off by sharing a few key Invest Right resources that we think will help you on your journey. So, as I said, my name's Chelsea. I'm here. I'm really happy to be here with Malka discussing a topic that really impacts everybody and can truly change your life, better for the better or for worse. So, growing up, I received the message of save your money. And that sounds good, doesn't it? Save your money. And I was quite proud of myself. I had a savings account, unaware of what I was missing out on because that savings account had a 0% interest. I eventually started investing because my bank recommended it. And while my bank was helpful and continues to be helpful, they always had a product to recommend that would hold my investments. And it wasn't until my early 30s that I started to learn about what investments I was holding and the power that knowing those investments and having investment goals can have. I really wish I could talk to that 15-year-old who was working their first job, washing hair at a hair salon, and tell them about compound interest, but better to start in your early 30s than never. So over to you, Malka.
Thanks, Chelsea. I'm equally delighted to be the co-speaker on a topic that I live and breathe every day. Growing up, I wasn't provided with the financial education I needed to succeed with my money goals. Coming from a struggling immigrant family, the emphasis was always on frugality, savings, and steering clear of debt, and investing just wasn't discussed. It wasn't until my late 20s that I started exploring investing as a way to achieve my goal of financial security and early retirement. And since then, my path in investing hasn't been without its share of pitfalls and successes. But nearly a decade later, I find myself more confident and knowledgeable as an investor. So, through this masterclass, I'm hoping to help bridge the investment knowledge gap and empower all of you on your financial journeys.
Okay, so let's kick it off with a question that I actually get asked a lot when I tell people where I work. Who is the BC Securities Commission? And no, we don't regulate security guards. We call ourselves the BCSC, and we are a crown agency responsible for regulating investment markets in BC. We also protect investors from investment fraud and misconduct through education. So, what we do is set the rules for securities trading within the province of BC. We enforce the Securities Act, take action when necessary, and we also educate investors on how investing can help you reach your financial goals and, again, protect yourself from fraud. One common misconception about us is where our funding comes from. We are funded by investment industry fees, not by taxpayer dollars. So that means we're self-funded by market participants. And those are people who are in the business of buying and selling securities or companies issuing shares. When we do have enforcement action and when there is a financial penalty, money we receive from those actions goes back to the investor who lost the money. And then above and beyond that, it goes to our investor education program. And that's the program that I am managing. And that's the reason you're here with us today. So, what we do is a bit of a balancing act, and you'll see that here. So, we watch over the capital markets or the investment markets to make sure that they're fair and dynamic. We want to make sure the market can fulfill its role of providing capital or money to companies that need it, which of course leads to a more vibrant economy in BC. But we also want to make sure that investors are protected from scams, unfairness, or people who are looking to evade the rules. Our job isn't solely to protect investors to the max, because if it were in some way, our job might be a little bit easier. We would simply ban average investors from taking risks, which incidentally would also reduce returns. So our job's a bit more complicated because we don't want to inappropriately stifle the flow of capital or money to businesses that need it. Our overall goal at the BCSC is creating a market in BC and with our fellow securities regulators across Canada where people can invest with confidence and companies can flourish.
Okay, on to the fun stuff. So you might be wondering why we're running this masterclass. Because as a Crown agency, we're well positioned to provide unbiased investing information. So we're not here to sell you products or sway you toward a specific investment strategy. Our goal is to arm you with the knowledge and information you need to invest with confidence. The information presented today is based on research that addresses the unique needs and perspectives of women. We know women face distinct challenges and opportunities when it comes to investing, and we're here to provide you with the guidance and knowledge you need to succeed. Let's start with the basis you need not only when you start your investing journey, but while you're in it too, because personal circumstances are always changing. No one's investing journey is straightforward, and no two investing journeys are the same. So it's important to know your financial self. This means understanding your financial goals, risk tolerance, time horizon, and investment knowledge. It takes time and patience to build a good long-term investment plan. So be honest with yourself and be open to learning because overestimating your investment knowledge can lead to problems.
So, there's a basic question you can start with to help you learn about your financial self. And that is, are you an investor or a saver? Or maybe you're both. It's important. It's an important question because identifying as an investor is really significant. It can make a big difference when it comes to managing your financial goals. Our research shows that people who identify as investors are more likely to understand the risks and the benefits of their investments, more likely to be on track to meet their investment goals, and more likely to have an understanding of things like fees and charges that could be associated with their investments. Women specifically consistently feel the word investor doesn't describe them. Our research showed only 22% of women describe themselves as an investor. So there are women out there who are investors who don't feel like investors, and it's important to identify as one. Now, are you an investor or are you a saver? Well, you're an investor if you've placed money in any type of account or product that has potential to earn interest or more interest than what a traditional savings account would provide. You're a saver if you put money in a savings account and nowhere else. Whether you're an investor or a saver, and both are good, decide what you want to accomplish with your money and when you want to accomplish it. It sounds pretty simple, doesn't it? Your financial goals, as Malka said, are unique to you. So, whatever your situation, it's important to consider where you are now and where you want to be in your future. Setting goals is an important first step towards becoming financially secure. It's almost like when you're learning to run a race. You choose a race that you want to run and you set the steps that it will take to get there. Without goals, it's hard to be persistent and it's hard to strive towards a better financial situation. But when you have that specific goal, you're more likely to take the necessary steps to achieve it. So your goal might be retirement, your goal might be a vacation, a car, a down payment. It's up to you. And you can have more than one goal. And once you've figured them out, you can start thinking about your specific time horizon and learn what your own risk tolerance is. Time horizon is the amount of time you have to meet your financial goals. And within that time, make up for any losses that you might experience. An investor with a long time horizon, so if you're thinking about retirement and you're currently in your 20s, that long time horizon may make you more willing to accept risk than someone who's saving to meet a short-term financial goals. And then risk tolerance, well, it's how willing or how comfortable you are to risk losing money on an investment in order to achieve your investment goals. And again, that risk tolerance, how comfortable you are with risk, is unique and different for each person.
We're aware it's simple to provide tips for your investing journey, but putting it in practice as a woman can be challenging. Women face career interruptions because they're more likely to take maternity leave, which can make it challenging for them to focus on career growth and wealth building opportunities. There are also social and cultural factors that influence a woman's ability to work and build wealth. Even just thinking about the fact that in some of our lifetimes, women couldn't buy a house without a male cosigner is astonishing. Women haven't had the luxury of accessing money for as long as men have, so it's no wonder we're not as confident when it comes to investing. Women still face wealth building challenges, even in first world countries like Canada, a big one being the gender pay gap. According to Statistics Canada, as of 2021, the gender pay gap for full time employees is 90 cents, which means women make 90 cents for every dollar men make. While the gender wage gap has been declining over time, a substantial gap still exists in many countries. So globally, women only make 77 cents for every dollar men earn. And at current rates, it will take 70 years to close this gap. This is a major cause of lifetime income inequality. When women are ready to retire, they often have saved only 2/3 of what men have saved, yet they have to plan for a longer retirement as they tend to outlive men by an average of 4 years. Globally, nearly 65% of people above retirement age without any regular pension are women. So you may be wondering why the needle is moving so slowly in terms of change. It's because there needs to be more understanding in how gender roles emerge as a response to specific historic circumstances and are highly persistent even after circumstances change. So, strong transmission channels from parents to children cause long term persistence of gender roles in society. So, if women were not responsible for financial decision making historically, it might take a long time for them to become decision makers today, even if circumstances have changed. This is also why it's imperative to pass down financial knowledge, especially to young girls. By sharing this valuable knowledge with young girls, you help set them up for a better and more secure financial future. You help close the financial literacy gap and give girls the confidence they need to succeed with their future money endeavors. As the mother of a young girl myself, I fully intend on sharing my financial knowledge with her so that she's set on a path of financial empowerment early on in life. I just have to figure out a way for her to shift her focus from investing in a stockpile of teddy bears to investing in actual stocks. So, when it comes to investing, confidence is key. Although confidence is rising among women, they still feel less confident than men when it comes to making investment decisions. So, as the graph here shows, about 60% of women say they're confident, whereas closer to 80% of men say the same. Even with this rise in confidence, women feel more anxiety about losing money on investments. About half say they're anxious. And they're also less optimistic than men that they will be able to achieve their investment targets. Women also have consistently lower financial knowledge than men. So about 56% have low knowledge compared to only 38% of men. But this hesitation and instinct that we have to pause can actually be a good thing. Take, for example, that men are more likely to be speculative investors, which is a behavior that's correlated with higher risk. Among women, we see consistently less speculative type investing behavior. Women also periodically gain higher returns because they avoid high risk trends, they stay calm amid volatility, and they take a more passive approach to investing. While it's true, it wouldn't hurt women to gain more confidence in investing. We also don't need to be overconfident either because we already have good instincts when it comes to making smart investment decisions. So instead, try building on that investing confidence. You can do this by getting comfortable with risk. Our research shows being confident and being comfortable with risk go hand in hand when it comes to investing. As Chelsea mentioned before, investment risk is the degree to which you're willing to lose some or all of the money you've invested. Investors take risks to earn dividends, interest, or capital gains to increase the value of their investments over time. It's important to remember that all investments come with risk. So, generally, the higher the potential return an investment might offer, the higher the risk will be.
Getting started with investing is kind of like building a house. You want to start by building or maybe maintaining a strong financial foundation. So, investing isn't the first thing that you want to do. You want to make sure you have an emergency fund. And this is really important because it can help you pay for unexpected expenses, hence the name emergency fund, and avoid taking on high interest debt. So typically, your emergency fund would be in a bank account that's easily accessible if needed. It could be for things like car repairs, family emergencies, job loss, illness. And you would typically want your emergency fund to hold 3 to 6 months of expenses. Debt is also something that plays a significant role in your financial position. So while investing is very important, it's equally important to manage debt responsibly. High interest debt, like a credit card balance, can be a significant drain on your finances, but not all debt is bad. So consider the debt you have and the debt you may take on in the future and how it could affect your financial goals and your ability to invest. And that starts with as well just recognizing what your expenses are and budgeting accordingly. When it comes to investing, you can start small and it helps to be consistent. You do not need to be rich to invest. I feel like I need to say that again. You do not need to be rich to invest. Many investment platforms allow you to start small, and consistency is key. So even if it feels like a small amount, just making that habit to set aside a portion of your income each month for investing, those small regular contributions can accumulate over time. As Malka mentioned, embracing risk and long-term thinking are important. And if you have a longer time horizon, you have an option that others may not, taking more risk with your investments because you have more time to ride out market fluctuations and capitalize on opportunities. Now, embracing risk does not mean being reckless. It simply means being informed and strategic with your choices. This is also a time where you can experiment with different investment vehicles. Malcolm will talk about them in a bit, but things like ETFs, mutual funds, stocks, bonds, it's a time to learn about your experiences, which helps you make wiser decisions in the future. Investing is an effective way to have your money work for you and build wealth. So while holding cash and bank account savings in a bank account, those are considered safe strategies. Investing your money allows it to grow in value over time with the benefit of compounding and long-term growth. Investing is not a get-rich-quick scheme. Despite what many people on the internet will make you think, investing is not a get-rich-quick scheme. You shouldn't be expecting instant wealth, but instead slow and steady progress over a period of time. In fact, sometimes if you're doing it right, it can be downright boring, and that's a good thing. The historical performance of stock markets is undeniable. Yes, market cycles have downward trends, but overall, the markets historically have trended upwards. Even when markets are down, you may find an unexpected opportunity to enhance your portfolio or even invest more if your time horizon and your risk appetite can accommodate that approach. Diversification is key to most successful investing strategies. So if you have a Dalmatian, make sure you also get a spotted dog and a striped dog. One way to reduce risk in your investment portfolio is diversification. So it doesn't necessarily make you more money or stop you from losing money. It simply means you're not putting all your eggs in one basket. If you hold just one investment and it performs badly, you could lose all your money. If you have a portfolio that holds a variety of different investments, it's less likely that all your investments will perform in the same way. So in a diversified portfolio, there's different types of investments so that when there is a downturn in a category, you have other ones that help cushion that impact. That asset mix you choose is important to the overall risk and expected returns of your portfolio. And having that right asset mix helps balance your risk with the expected rate of return on those investments. Again, that asset mix and the diversification of your portfolio should fit your own personal risk tolerance and let you access your money when you need it while providing growth you need to reach your investment goals. And your asset mix can change as your needs and your goals change.
In general, you have three options when it comes to how you manage your investments. You can use a registered investment advisor, a robo-advisor, or look after your own investments through self-directed investing. Registered investment professionals have a wealth of knowledge, experience, and guidance that can make a substantial difference in achieving long-term financial goals. If you choose to use one, an investment advisor will play an important role in helping you select suitable investments and managing your portfolio. They have an obligation to know your financial situation and outline the risks involved with investment recommendations. It's important to note that an investment advisor that sells securities, so stocks, bonds, mutual funds, or ETFs, must be registered with a provincial securities regulator like the BCSC. Always do a background check on anyone who claims they're registered to sell investments so that you can protect yourself from a potential investment fraud. There are a number of things you can expect when working with a registered investment advisor. They should make clear and specific recommendations and explain how their recommendations will help you meet your financial goals. This should include explaining the risks involved with every investment they recommend. They should answer your questions about investment products and strategies. If you don't understand something, always ask for clarification until you feel comfortable committing to an investment. They should get your permission before buying or selling investments on your behalf and confirm it in writing. Unless you have a discretionary account or you've given someone else trading authority or power of attorney over your account. They should provide information about the fees you pay and the performance of your investments, and they should keep your personal information safe, send you regular account statements, and meet with you at least once a year to review your information, progress, and update your plan if appropriate. Now, as the client, you also have responsibilities when it comes to your working relationship with your investment advisor. Open and honest communication is the foundation of any successful relationship. Be clear about your financial goals, risk tolerance, and any specific concerns you might have. Schedule regular meetings with your advisor to review your portfolio's performance and discuss any life changes and reassess your goals if necessary. By taking an active role in your relationship with your advisor, you can maximize the benefits of professional guidance while also maintaining control and awareness of your financial future. The value of good advice comes with a price tag. Your investment advisor's firm is compensated through fees and charges, so you need to know what the fees and other charges are, what you'll get for them, and how you will pay. Now, while the fees you pay will reduce your overall returns, it's important to recognize that you're paying for expert guidance aimed at securing your financial future. If using an investment advisor isn't right for you, there are other options available to help manage your money. You can use a robo-advisor or look after your own investments through self-directed investing. Robo-advisors, also known as online investment advisors, use technology to lower costs and create processes such as opening an account that require minimal to no direct human contact. You'll likely be offered standardized model portfolios containing lower cost investments, such as ETFs. Because of their lower operating costs, robo-advisors can charge lower fees. Self-directed investing is where individual investors build and manage their own investment portfolios. This is an option for highly active and highly involved investors. Self-directed investors decide which investments they want to buy and sell and when. Typically, they use discount brokers and online trading platforms to make their trades. As a result, they pay lower commissions and fees because they don't get advice about the investments they choose to make for themselves. You might consider self-directed investing if you want to be very hands-on with your investments and develop your own plan.
So the investing world can be very exciting. But unfortunately, fraudsters and scammers take advantage of this excitement. Our website, investright.org, has about 20 different types of investment scams. That's a lot. One scam I wanted to highlight today that's gaining traction right now has a bit of an unpleasant name. It's called a pig butchering scam. So, this scam involves luring individuals into online relationships, sometimes through a dating app, to build trust before convincing someone to invest money in what seems like potentially a legitimate or profitable venture. Typically, these scammers promise high investment returns within a short period, which is a red flag. Pig butchering scammers often use stolen images and fake investment websites to convince victims of the legitimacy of their schemes. Once victims are hooked and have invested money, the scammers disappear, leaving victims with no way to recover their funds. This can often be through a romance scam. Often there's crypto involved. And the term pig butchering is derived from the idea that the scammers fatten up their victims with the promise of lucrative returns before slaughtering them for their money. And it's important to know that's not where the scammers end. There's also something called a recovery room scheme. So, what might happen is a scammer may take your money and run away with it, and you're left wondering what happened to this best friend that you made on the internet. And all of a sudden, someone contacts you and says, I can help you get your money back. All you need to do is pay for our services. Well, those services are also a scam, and you won't get your money back there either. So, the best way to protect yourself from becoming a victim of investment fraud is to steer clear of any investment that offers a guarantee of high returns and or no risk. Remember, Malka said this earlier, every investment comes with some risk. So if somebody's saying high returns, no risk, red flag. Never let your emotions get the best of you. And one emotion in particular is FOMO, the fear of missing out. Fraudsters and scammers are skilled at making it sound like their offer is making everybody else rich and you're sitting on the sidelines. They may pressure you to invest very quickly to get in now or never. So if you feel that pressure or you feel that FOMO, that's also a red flag. Avoid investment offers from anybody who's pressuring you to invest. Any legitimate investment will allow you to take your time, do your due diligence, conduct that background check on the investment or anyone trying to sell you the investment. Now, if you do suspect investment fraud or market misconduct, report it to us immediately. The sooner we're aware of the fraud, the sooner we can take steps to stop it. Now, some people avoid reporting that they've become a victim of fraud because they're embarrassed. It's important to have the courage to report that fraud so that other people don't fall for it.
And that concludes the educational component of this webinar. We're now going to share a few informative resources to help you continue your empowered investor journey. So as Chelsea mentioned at the start of the webinar, a key goal of the BCSC is to empower investors to protect their financial interests and become better informed about investment products and services. We do this by providing unbiased investing information through our investor education website, investright.org. This website provides investors with online tools and information to help them make wise investing decisions and protect themselves against unsuitable or potentially fraudulent investments. All of the information on InvestRight is based on research.
We have many tools and resources on InvestRight, but I wanted to highlight a few that you may find relevant and helpful. Now, the reason we're here today talking about women in investing, we have a specific page for women in investing. It's our latest and newest guide on investing specifically designed for women. The guide provides research backed, and when I say research backed, this is research that the BCSC has done over years. It aims to not only bridge that gender investment gap that Malka spoke about, but also instill that reasonable confidence in women when it comes to making informed investment decisions. We also have a video series called Get Started with Investing. It's divided into two parts. You can take it at your own pace. The first part takes you through the basics of investing, and the second dives into more complex investing topics like the private placement market. InvestRight also has a few different calculators. One that I want to highlight today is our retirement calculator. So it provides insight on how investing can, guess what, impact your retirement. You can use this calculator to estimate the total value of your investments at retirement, as well as how much money you could have during retirement. And it's good to spend some time on here and think about, if I had this much, this is what I'll end up in the future. It also gets you thinking about things like, when do I want to retire? How long do I expect to be in retirement? Just thinking about it is a good way to get started. Now, we talked about fraud today and the fraud warning signs, but you can learn more about the 5 key fraud warning signs in more detail so you can help protect yourself and your loved ones from investment fraud. Now we'll jump into answering some questions that we get all the time. First of all, how much money do I need to start investing? Well, as I mentioned earlier, you really don't need a large sum of money to start investing, but you do need to make sure that you're in the appropriate financial position that allows you to be comfortable with that risk that comes along with investing. So it's really a question of math. In order to figure out how much you have to invest or start investing, you want to consider things like income, expenses, that emergency fund, debt, and if you have dependents. And once you've got that into account, any money you have left can be put towards investing. And that might be $5, that might be $1,000, that might be anything less, more, and in between. But there's no minimum to get started with investing and feeling like and being an investor.
Next question. Which investment account should I use? So there are a few options when it comes to investment accounts, and the one you choose depends on your financial goals. You can open an investment account or an unregistered account that will allow you to buy, sell, and hold investments. In an unregistered account, you are taxed on your gains. You have probably heard of RSPs, TFSAs, RESPs, and first home savings accounts. Each of these specialized accounts allow you to hold investments and have certain requirements that you need to know about before you sign up. These accounts also allow you to hold investments, not just cash. Over time, you'll find yourself using more than one of these accounts. It will all depend on your financial goals and needs.
Okay, the next question is one I get every time I go to a dinner party. What about crypto? Should I invest in crypto? How do I invest in crypto? So, a cryptocurrency like Bitcoin is just computer code, and there's little or no connection to cash. Access to the crypto asset market is pretty much readily available to anyone, but just because it's available doesn't mean it's the right investment for you or for anyone. Crypto assets are high risk investments. We've talked about risk. Crypto is high risk, and it comes with little investor protection. Crypto can be bought or sold on a crypto asset trading platform, And these platforms may not have the controls that keep your money safe. Many of these exchanges are based outside of Canada, which makes it difficult to recover money if it goes missing. That said, if you do choose to invest in crypto, it's a smarter decision to use platforms that are registered with Canadian securities regulators. They have obligations around safeguarding customers' accounts. Still, if a platform ignores those obligations, your money could be in jeopardy. You can see a list of the crypto trading platforms authorized to do business with Canadians, along with a list of banned crypto trading platforms by visiting the Canadian Securities Administrators online.
What do I need to know before investing in a private company? So, unlike public companies, private companies don't have to issue a formal prospectus, which is a formal document required by law when a company wants to sell shares to the public. Without the information provided in a prospectus or other ongoing disclosure that regulators require from public companies, the onus is on you as the investor to gather information about the company yourself in order to make an informed decision. So be sure to find out as much as possible about its management team, financial situation, viability as a business, and financing activity.
Okay, and our last frequently asked question, what should I invest in? Well, I'm the wrong person to ask. I'm not a registered investment advisor, and the BCSC cannot and does not recommend or give investment advice or recommend advisors. But what we can do is answer general questions about products and services. We can tell you if a firm or a representative is registered in BC. We can tell you if the BCSC or if another securities regulator has disciplined an individual or company. And we can suggest options when it comes to pursuing complaints or tell you which organization can be of the most help. So that's it. If you'd like more information on investing, you can visit our website, investright.org. We encourage you to subscribe to our monthly newsletter so you can stay informed on investing topics and trends. And of course, please follow us on social. We are on Twitter/X, Facebook, and our relatively new Instagram account.
And on a final note, investing may seem complex, but every successful investor started with curiosity and the courage to take the first step. The fact that you're attending this webinar to learn more about investing and gain the confidence you need to take control of your financial future is a step in the right direction. The BCSC is here to offer support, so if you have any investing related questions, please get in touch with our contact center. Thanks for joining, and we wish you the best on your investor journey.